Well, folks, it's happening. The same thing that happens in every single crash toward the end. Retail starts selling, and this crash is no different. We got new data out here. Got to talk about this. Now retail is actively selling stocks. Not only are they not buying the dip, they're actually selling pretty heavily now at this point in time. So we got to talk about that new data. We're going to talk about Tesla stock. We're going to talk about my feelings on those earnings. We're going to talk about the numbers. We're going to talk about what my plans are to do with that stock. Got to talk about the market. We're going to talk about the mortgage market in housing and how bad things are really going to get there. Some really troubling data out here today in regards to housing, which comes as no surprise to me, and I'm sure a lot of you guys that are watching this video here today. Hope you guys enjoyed it as always. I appreciate everybody for joining me. And also, if you want to get up to 15 free stocks from Moomoo, check out pinned comment down there. They do have that deal going on this month. The stocks will be valued up to $2,000 there. Okay, so new data out of Goldman Sachs here. Just devastating, and it happens every single time. So what you're looking at here, this light blue line, that is essentially like retail buying. Okay, retail buying or selling, and doing it with NASDAQ 100 stocks, which are obviously super popular, right? And as we see throughout time, at least over the last several years, it's always been where retail is buying stocks more than they are selling stocks, right? It's never gone negative. The zero is like the break-even number, right? And then if you go to the negative numbers, obviously, you're talking about retail selling at that point in time, right? And so obviously retail was buying heavy in the stimulus situation, right? And there was obviously just a lot of excitement, FOMO in the market, and retail was buying incredibly heavy during this moment, right? And then things start to chill down a bit in 2021, and then kind of going into this year, it was set to kind of be an exciting year, and there was a dip in the market early on, and retail bought that heavy, right? And then after that, unfortunately, Russia-Ukraine happened. Inflation went crazy after that. Commodities spiked high, right? But throughout most of this year, retail's been still net buying, right? They just didn't buy as heavy, and the buys got less and less and less as the market went down and down and down. And you see a clear difference, right? Where also now the NASDAQ's way above where retail was buying at this point in time, which if you look at the last several years, it was almost always where retail was buying heavier than that NASDAQ line was, right? But here over the past month or so, unfortunately, it has now gone to selling. Yes, retail is now net sellers of NASDAQ 100 stocks, and that's unfortunate, man. And it happens this way every single crash, and especially toward the end. At first, retail will buy, and then the buys get less and less and less, and then those buys turn to sells. And that's exactly what we see going on right now, which is it sucks, man. It sucks. Now, why has this happened, right? Why is this going on? Well, think about it like this, right? If we just look at some of the most popular retail stocks, right? Let's just go through those and just see how these stocks have done, right? NEO stock, one of the most popular retail stocks, certainly on YouTube, of 2020 and 2021. And this stock is down 67% year to date, right? That's just, for the retail crowd, which is this a stock they obviously own heavy as this being one of the most popular YouTube stocks, no doubt about it, right? In 2020, 2021, when you talk about that sort of loss, it's devastating. And every single time you bought the dip in the stock for the last year, you've gotten obliterated, just absolutely obliterated, right? Shopify, this stock's down almost 80% year to date. Definitely a pretty exciting retail stock because it has that insane growth, right? And what do you get? You just get down, down, down. The ARK ETF, obviously, Cathie Wood, that was obviously a huge FOMO cycle in ARK in late 2020 and into most of 2021, right? And, the ARK fund is down 63.5%. That's an ETF. It's not like that's an individual stock. That's an ETF down that much, right? So every time you buy ARK, you just go down more and more and more. Palantir, pretty popular retail stock out there, down 57% this year. Just about every single time you bought Palantir, you're down, right? SoFi, popular retail stock, down 68% year to date. AMC, obviously there was that whole thing, Wall Street Bets. By the way, I went on Wall Street Bets like a week or two ago. It is dead in there. Like compared to what it was a year or two ago, oh my gosh, it is like a ghost town inside Wall Street Bets now. It's incredible. It's almost eerie, just going in there and just seeing like how little activity there is, how little posts there are, comments, like compared to what it was a year or two ago. Oh my gosh, it's literally like night and day. And, that stock's down 62.5%, right? The Chef, 72% down. I never saw that one get into these prices. Never. I mean, $6, $7, $8. I saw that $4. Come on, man. Never saw that in a million years. And even the savior of retail, which is Tesla stock, right? The savior, that's down 44%. And that's going into this earnings, which, we're going to talk about Tesla later on in the video, but the stock is down after hours. So we'll see where that trades at tomorrow, right? But it's very possible, Tesla could end up down 50%, so cut in half. And this is the savior of retail, right? And when you talk about that stock's been nearly cut in half, oh my gosh, okay? So absolutely devastating. So imagine a scenario where you're at McDonald's and you go up there and you're like, I want a Big Mac and a fry and a Coke, right? And you pay. And then you're waiting there and you're like, hey, can I get my food? Like, is it almost ready? And they're like, oh, no, you got to pay again. And you're like, what? I already paid, man. I want my food now at this point in time, right? And so then you got to go up and order again. You pay again, right? And then they don't give you your food again. You're like, oh, no, you got to order again, right? At some point in time, you just get frustrated and you're like, screw this, man. I'm out of here. Or you're going to fight somebody or something, right? And that's kind of how retail feels in this whole situation. Every single time, they've gone to buy whatever stock, they haven't gotten anything from it. It's just down and it's down, and it's like you buy the dip and it's down more, and you buy the dip and it's down more, right? There's no like, at least this stock's doing good, at least for almost all the popular retail stocks, right? Pretty much every single one of them is down 50, 60, 70, 80%. And so every single time, even if a stock goes up for 1 week, people are like, it's probably just going down more. It's just a very, very frustrating ordeal. And this is why in every single one of these crashes, right, retail leaves, they give up on the market. Some give up on it forever, and some just give up on it for, let's call it a few years until things bounce back year after year after year. Then they start hearing stories about people are making so much money in the market, right? And then slowly but surely, people start getting involved in the market again and saying, ooh, this thing looks interesting. My neighbor, he just made $40,000 on stocks this year. Man, that's like half my salary. I'm going to start getting into stocks. It happens every single time, right? And why else is retail leaving? Well, think about it like this, right? If you've looked at the University of Michigan consumer sentiment, which has been done for decades and decades and decades, right? Those numbers have been among the lowest over the past several months that we've ever seen in history, right? So if you're talking about retail, right? That is the same exact people that are in that consumer sentiment number. So if people are so not confident, why would they buy stocks? Most of them won't, right? Like most aren't going to buy stocks if they're not feeling confident. And so that's something that matters in a significant way. Something like consumer sentiment. It's way bigger than just consumers going out there and spending money. It has to do with stocks and investments as well. And if they're not feeling confident, that's a no bueno situation, right? If you look at the fear and greed index, right? We're at extreme fear in almost everything. Almost everything's at extreme fear in this market. And, it's easier to say buy the dip when the market's fearful and those sorts of things, right? The great old Warren Buffett quote that's, buy when others are fearful and sell when others are greedy. That's a phenomenal quote. But unfortunately, for most people, it's much harder to do that than to just say it, right? It sounds beautiful, but most people have a lot of trouble buying in times of extreme fear, which obviously, based upon just about every single metric you want to look at, the market's in extreme fear right now and has been for a bit, right? If you look at the AII investor sentiment number, we've been in incredibly high bearish numbers. So nobody's got confidence out there. You got, horrible investor sentiment numbers, right? And the market's in extreme fear. I understand why retail has been, even though it's not the right decision, unfortunately, I understand why retail has been selling and selling over the past 1 to 2 months, and they're no longer buying the dip because they just get punched in the face every single time. And it's like, what am I buying for? The stock's just going to be lower next week, next month. And that's begun to become the norm out there. And unfortunately, people are now selling at this point in time. That's frustrating. It's the wrong decision. It's always the wrong decision, but it is the decision that's being made in the short term. Okay. Now, when I got in the market, right? There's a whole picture of me I found from 2009, my first time ever in Vegas. You can tell it's 2009 based upon the way I'm dressed. Oh my gosh, the swagger's out of control. Look at this. Okay, I got the jean shorts on. Looks like I got some sort of necklace there going on, chain. And then what is this? Are those Nikes or those AN1s? What I got going on there? Oh my goodness. Okay, too much swagger going on there. But in all seriousness, when I got in the market in 2000, at the end of 08 and into the beginning of 09, and I told anybody that I was getting in the market, right? I got zero support from anyone. Zero support from anyone. There was no one who's like, oh, good for you, Jeremy. Yeah, you're getting in the market. Oh, that's awesome. You know, yeah, you're going to buy stocks. Oh, you're going to take this stuff serious. Zero support from anyone. And why was that? Well, we're talking about, I was getting in the end of 08 into the beginning of 09. The market had been devastated. Retail, anybody that had investments, it didn't matter if you owned index funds, didn't matter if you owned ETFs, didn't matter if you owned individual stocks. Everybody got wrecked, right? Everybody was tore up. So why would anybody say, go get them, Jeremy? You're going to do great. This is awesome. They were all mentally just drained from that situation, right? Remember, the indexes went down 50% in 0809 crash, right? Peak to trough. So even if you had a retirement account or something like that, right? A 401k, you were down 50% from where you were at in the summer of 2007. Think about that for a moment. So that's why I got no support. And the same exact thing is going to happen right now, right? Imagine, somebody was, over the next 6 months is getting into the market for the first time. You think they're going to get any support? No, of course not. Because everybody's seeing what's going on in the market, right? And they're like, you shouldn't be getting involved in that thing. Look at everybody's losing money. Look at all these stocks down this much, right? And we haven't even seen the S&P get hit nearly as hard as many of the other stocks, right? Which kind of is a little more reminiscent of a little bit of kind of the tech bubble situation there, right? And so that's unfortunately what happens. And if you imagine, even if you went back to 2002, let's say, for instance, after the tech bubble went boom, even in that scenario, if you were somebody getting in the market, people are going to say, no, that's just a casino, man. That's just a casino gambling. Like, what are you doing there? Don't be getting in that stock stuff. Because why? They'd seen it became a casino, right? And obviously 98, 99, and then everything came crumbling down. And so it's unfortunate. It happens every time. This crash is no different. The next crash will be the same thing. It will play out the same way, right? And everybody will say, don't get involved in the market, and it's a waste of time, and people will be net sellers of stocks, and it's unfortunate. But it is what happens. It is part of the process. And as a participant in the market, we do have to understand this is just part of it, man. And there's nothing we can do about it. There's nothing I can do about it. I can, tell people a million times, look at, every single crash in history you should have been buying. It doesn't matter at some point in time, right? People are just done. They're just burnt out, right? And they've just lost and lost and lost. And like, I don't want to do this anymore. It's unfortunate, but it is what it is. And it's the same exact story again. Okay. Tesla. So we go to Tesla, my Tesla. Down 3.5% after hours. We'll see what happens, obviously, on the conference call and, tomorrow's trading, right? Tesla's a crazy stock, so it can make some wild moves. And remember, there's always a lot of money that backs Tesla, so they're going to try to prevent that stock from going down tomorrow. And obviously, the stock has been hurt very heavily. Now, in regards to numbers, almost everything was great. I got a few red things here. Yeah, we'll talk about, just talk about the green first, okay? Automotive revenue is up 55% year over year. That's ridiculous. I mean, who else is putting up those sorts of numbers in this industry? It's incredible. Absolutely incredible. Automotive gross profit was up 42%. That's an incredibly great number, right? Operating expenses up 2%. So operating expenses haven't risen that much that you would think they would have, right? Year over year. Income from operations is up 84%. That's an amazing number. Operating margins up 262 basis points year over year. Incredible number. Adjusted EBITDA is up 55%. Adjusted EBITDA margin was only down 13 basis points, which is basically break even. So that was good. Net income attributable to shareholders on a GAAP basis, right? This is generally accepted accounting principles, up 103%. These numbers are incredible. Non-GAAP up 75%. EPS on a GAAP basis was up 98%. GAAP EPS was up 69%. Non-GAAP, up 69%. So the GAAP numbers always matter more than the non-GAAP numbers for a profitable company. And these numbers are incredible, right? Net cash provided by operating activities was up 62%. Capital expenditures was actually down 1%. Free cash flow was up 148%. Cash and cash equivalents and marketable securities up 31%, which, companies just adding more and more to the bank. It's incredible to see these sorts of numbers when, it was just a few years ago that A lot of folks on Wall Street were talking about Tesla was going to go bankrupt. Literally, there was a talk on Wall Street for 2018, 2019. A lot of people thought this company was going to go under and they weren't going to make it. And to see, now them having $21 billion of cash equivalents, and marketable securities, and the numbers is going to keep building unless they do some sort of share buyback or something like that. The numbers are going to keep building and building and building, which is amazing, okay? Now, as far as the red numbers went, automotive gross margin was down 258 basis points year over year. So, that's not ideal. We want to see that going up over time, and that's going to be something that worries Wall Street. A lot of the Wall Streeters is going to, they care a lot about margins. And so if you're wondering why that stock's likely selling off after hours, at least a few percent, it has to do with that gross margins, okay? As far as total revenues and gross profit. So the fact that basically gross profit rose at a less number than total revenues isn't ideal. So if we're going to say something's bad, we can say that's bad. And total GAAP gross margin was down 152 basis points, which is like 1.5% there, right? So that's not ideal. But overall, the numbers were pretty darn amazing, to be quite frank. Not a lot of bad in that, just a lot of great and amazing numbers, right? Now, it was interesting. While I'm prepping this video, I had Fast Money on in the background, right? And it was so funny because the guy that was hosting, Melissa Lee, wasn't on it today. So some guy on there, I think it's Brian Sullivan or whatever, right? He's like, well, what if you just slap a same valuation on that like a VW has on it, or a VW or whatever. And I'm just like, that's just ridiculous. It's the same thing they've been saying for 100 years in regards to Tesla. Why should it trade at this valuation versus GM trades at this, and Volkswagen trades at this, and Toyota trades at this, right? And it's like, those companies don't have those numbers. Like, I don't know why this is so hard for these folks to understand, right? They don't have the numbers Tesla has. Tesla has ridiculous growth. That's like saying, Amazon over the past 20 years should have traded at the same valuation Walmart trades at. It doesn't make any sense. They're two totally different trajectories in their company's histories, right? So it's just funny that same talking point's put out there again and again and again. And it's like, why does this deserve a premium? And it's like, just common sense would be good. This isn't super sophisticated, high finance related things. It doesn't take a rocket scientist to figure out Tesla's growth, ridiculous. VW's growth is like, Toyota's growth is like, and why should they trade at the same valuation? That doesn't make any dang sense. So it's just funny to hear that kind of put out there, right? Now, the big thing I think a lot of people are forgetting about, right? Everybody's still so caught up in Model 3 and the Model Y numbers, which is amazing, but everybody's forgetting that Cybertruck's coming in 2023, and that's just going to be a huge growth vector for this company. And the Cybertruck numbers are going to be absolutely amazing when they start putting those up. Remember, there's never been a more talked about vehicle I've ever seen in history than the Cybertruck. The Cybertruck made the Model 3 and Model Y look like they're like not even talked about. There's never been a vehicle talked about as much as Cybertruck. So wait to see the numbers when they start producing that Cybertruck in mass. It's going to be ridiculous. And if you want to talk about the next hype cycle building in Tesla, it will be once they start to actually ramp Cybertruck. It won't be when the first Cybertrucks start to get delivered. It'll be when they start ramping it. So think about like, basically it will happen about 2 to 3 quarters after Cybertruck starts getting, delivered to customers. So expect like 2 quarters after that. That's when everybody's going to start seeing the big Cybertruck numbers start coming in, and it mattered to revenue in a substantial way. And that's when everybody starts paying attention. And, you kind of start getting another hype cycle around Tesla stock, which obviously Tesla gets these hype cycles. Okay. In regards to me with Tesla stock, I'm actually at a point where I may actually be interested in buying the stock in 2023. I think it's kind of a rocky road for Tesla in relation to sentiment around the stock for the next bit of time. And the reason being is obviously with the Fed continuing to raise rates and, the cost of capital across the board as consumers, right, being elevated. I think there's going to continue to be a lot of worries about Tesla's demand moving forward. And when I say moving forward, I'm not talking about 5 years from now. I'm just talking about over 2023, essentially, where people are going to look at it, and this can be completely wrong, but they're going to look at it and they're going to say Tesla's going to have demand problems. People are going to cancel orders because the economy's not going to be in as good a spot. And that's where Wall Street's already at. They're already kicked the can down the road to next quarter in Q2 of 23 and job losses and those sorts of things, right? And so therefore Tesla's going to still be in a tough sentiment environment for at least the next 6 to 12 months. And then it will emerge from that, right? But for now, it's in a rough sentiment. I would call it that, at least from the Wall Street side, because that's just the way they're going to look at it. They're going to say, hey, it's so expensive now to buy a Tesla, and that's just going to be their perspective, right? Now, there are certain stocks out there that, if you're thinking about like, how do you get a stock to perform well, right? And a stock like Avant is down 29% so far this year, right? But in this sort of market, it's a win, right? You've got to come in with kind of honestly like ridiculous numbers. And so like a company like Avant, the quarters they've put up over the past few quarters have been absolutely amazing. And that stock hasn't gotten hit as hard as you'd think it's gotten, right? A stock like Fubo's come back a lot over the past 3 months. It's up about 41% in the past 3 months. And the reason being is they've got overwhelming demand for their product, right? And so if you're talking about, you can get a stock price to go up even in this horrible market we're in, but you need something very exciting going on to just try to perform decent, right? If you look at a stock like ELF, it's up 21% year to date in a year, and obviously the market's gotten trashed and tons of small cap stocks gotten absolutely obliterated, right? But their numbers have just been so overwhelmingly good that you just can't like deny it, right? And so, in this market, right? You can buy into stocks and you can get gains, or you can get into stocks that perform better than the market. It's just they have to put up just ridiculous numbers. And so just keep that in mind. Keep that in the back of your mind as we move forward in this market. Even if there's no major momentum come in the market over the next year, there's still going to be some stocks that go up. There's still going to be some stocks that perform well, but they're going to have to show incredible improvements in their businesses, either on the revenue line or the bottom line, net income there essentially. Okay. So in regards to margins, and they'll perform well, even in a tough environment. Okay. Now, mortgage demand drops to a 25-year low as interest rates climb. So mortgage rates as of today are the highest they've been in 20 years. Demand for mortgages to buy a home and refinance fell again as interest rates keep rising. It doesn't take a rocket scientist to figure out that, right? Mortgage demand hits the lowest level since 1997. The worst part is we haven't even hit the worst part yet for housing. It's going to get worse. That's the craziest part. When you see these numbers, it's like, we still got more to go there, man. We still got more to go. The number of borrowers who can benefit from refinancing is at a record low. Yeah, who the heck has a mortgage at 7+%? Like, if you have a mortgage at 7+%, what the heck are you doing? Why did you not refinance over the last couple of years? Like, what is going on? And this is, before we get into this, which is very important, for folks out there like, housing is going to continue to get worse. Doesn't that mean stocks are going to get much worse? Not necessarily. That's not really the way it works. Like, housing can continue to get worse while the market comes back. No different than, the market was already getting hit in the front half of this year, right? Look at the first 6 months this year. NASDAQ got wrecked. Russell 2000 got wrecked. And S&P 500 got hit pretty hard, right? And countless stocks fell in the first 6 months of the year, 50, 60, 70, 80%. Meanwhile, the real estate sector looked like it was doing just fine for the first 6 months this year. It was like, everything's fine here. We're hitting some record prices, doing things like that, right? And demand's still incredibly strong, And now all of a sudden you're seeing the dominoes fall the wrong way for real estate. Real estate lags the stock market by usually at least 6 months, sometimes 12 months, sometimes up to like 2 years, right? And you saw this play out in 2009. When the market started to climb back in February, March of 2009, right? Real estate didn't bottom for another 2 years. Think about that for a moment, 2 years later. So in this environment, you can get a situation where stocks actually start going up and performing great, right? And real estate continues to get worse and worse and worse, and the numbers continue to get worse. Those do not move at the same way. And no different than March of 2020, right? March of 2020, stocks bottom, start going up like crazy. Real estate did not make a big, huge move until at the very end of 2020 and into 2021. And that's when all of a sudden you start seeing, oh man, what's all this demand for real estate? It's going crazy. Look at all these new homes starting to be built, right? And look at what's going on with pricing. So there was a huge, like at least 6 months plus lag there in regards to obviously the housing market there, right? So that's just something to keep in mind, right? Home builders pulled back in September as buyers faced spiking mortgage rates that have made several increasingly unaffordable. September housing starts, a measure of new home construction, dropped 8.1% from August and 7.7% year ago. It's going to get so much worse because here's the thing, okay? When we talk about a housing start, what a housing start is, that's when they actually start like building the home, right? So some of these folks that let's say the housing start is happening now, right? For some of these folks, they might have ordered these homes, right, 3 months ago to 6 months ago, when at that time mortgage rates weren't as high as right now, right? Because there's a huge lag time between somebody actually going to buy a house and them actually starting to start that house, and the construction process actually starts. It does not like you buy and tomorrow they're all of a sudden building. It doesn't work like that. The states and the government, everything works so slow. The home builders have been in a situation where they have so many homes under construction that it takes them forever, materials, everything. So if anything, we're going to see housing starts get massively worse over the next 6 to 12 months, because the people that are going in to buy the new homes is just going to be worse and worse and worse for the next 6 to 12 months, right? Because not everybody just has $500,000 laying around that they're ready to go spend to buy a new home. Most people are buying on a mortgage, and most people are looking at it and they're like, 7% mortgage? Nope. And that's for, if you got great credit, you're getting a 7% plus mortgage. You could be the creme de la creme and you're getting if I went to go buy a house right now, guess what my mortgage is going to be? 7% something. That's just bottom line. Doesn't matter who you are, doesn't matter how much money you got, doesn't matter, your credit score and all those things. That's bottom line in this situation. So this is going to get way worse before it gets better. Starts bounce back a bit in August while mortgage rates briefly retreated. But since that time, mortgage rates have been on the rise, inching closer to 7%, hitting a 20-year high. Okay, a 20-year high. Now, it's going to get so much worse. It's going to get so much worse. And I hope the Fed, I don't even think they fully comprehend, the dire situation. Because what I'm looking at in the numbers is a lot of these home builders, they're good with homes being built until about the second quarter of 2023. And then after the second quarter of 2023, for most of these home builders, the homes in terms of the ones that are getting built are going to start drying up. And if you don't have much demand for new homes being built over the next, let's call it 6 to 9 months, it's going to be a dire situation, which then you're going to talk about massive amounts of job losses in the real estate sector at the back half of 2023. So in this whole situation, I think it's very important that the Fed understands that if they kill the real estate market, they're going to kill the economy. Literally. We've been okay with the economy as of right now because all the folks there's so many jobs. I say there's millions and millions of direct and indirect jobs because of new homes being built. The amount of companies that make money off a new home being built is ridiculous. The best thing to ever happen in the U.S. economy is a new home is built, right? And it's always built on debt. If you kill that, you kill ridiculous amounts of jobs. All the people that build the homes are all of a sudden out of work, right? All the people that sell the lighting and the garage doors and the front doors and the paint and all this stuff, right? And the tile work and the appliances, all those people, work starts to dry up, right? And so then, it's a killer for the economy. And the reason the U.S. economy got hit so bad in the great financial crisis wasn't just a credit crunch. It was the fact that the real estate sector was wrecked. And when you wreck the real estate sector, you wreck people's confidence, you wreck spending, and then you even wreck numbers like Home Depot and Lowe's and companies like that, because it's like, why would I go spend a bunch of money on my home? People like to spend money on their homes when it's going up in value. That's why Home Depot and Lowe's numbers have been so amazing in the last few years. It's like, one, everybody was at home, so they're like, I think I want to paint this house, or I think I want to go plant a garden in the backyard because I got nothing else to do. It's Rona going on, right? So that was a huge benefit to their business. The other one was they saw their real estate prices going up and up and up. So people stopped looking at it as an expense to spend on their home, and they start looking at it as an investment. As soon as people's home prices are going down and down and down, now everybody starts looking at it and they're like, that's an expense. If I'm going to repaint this house, that's an expense. That's not an investment. If I'm going to go put some money in the backyard or do the lighting over here, do this or do that, that's an expense. It's not an investment. That's the way people start looking at it. And that's what people started looking at. And obviously 08, 09, 2010, 2011, they were looking at it as, if I spend money on my house, that's an expense. That's not a savings at all, right? And so that's an interesting situation there, right? Now, I went to RH in Charlotte, beautiful RH, and we ate at this restaurant that's on the top of it for lunch. And when we were in North Carolina last week, there's nobody shopping for furniture in that store, man. No one. The restaurant was packed. We had to wait like an hour just to get a table for lunch. But the restaurant's big, but man, you're going to need to sell a lot of lobster rolls to make up for not selling $20,000 couches. I can tell you that much. So that just is another showing of where we'll see this devastation in a stock like RH. I wouldn't short the stock, but at the same time, do I think it's probably going down a lot more from here? Yeah. Am I going to be interested in buying RH stock at some point in 2023? Probably. But it's not today. It's not today, man. They've got a lot of troubling numbers and guidance to report over the next, let's call it 6 to 12 months. And that's just kind of the way it is, guys. So hope you enjoyed today's video. As always, get your free stocks from moomoo down there while they still got that. That will be pinned comment. Much love and have a great day.